Hey, and welcome to the Aaron Katsman Show. I'm your host, Aaron Katsman. I speak to you about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon-to-be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think somebody might find this interesting, go ahead and share it with them as well. So I'd like to speak again about all the volatility, the tariffs, the threat of a recession that everybody's talking about, and maybe some tips how to deal with stormy financial markets. So it doesn't take much to put investors on jitters, right? Just 3 or 4 weeks ago, everybody was talking about, wow, this is going to be amazing, and Trump and tax cuts and deregulation, and the market's just going to go to the moon, right? We were all-time highs, and then bammo. A tariff here, a tariff there, and all hell breaks loose. And now the media, everything changes on a dime, turns on a dime. The media is talking about the stock market's going to crash and it's imminent. And there's no question that President Trump's announced tariffs are causing lots of volatility in global markets. Worries about slower growth, a potential resurgence in inflation as goods become more expensive, peak uncertainty of what Trump's end game, what his plan really is, are sending investors to the sidelines, right? And to panic. No question about that. I've been getting a few calls, not so many. Thank God I've been training my clients that you should generally just stay the course. That's what's really, really important. But there are clients who call and they say, well, what should we do? So I said, the first thing you should do is take some Tums or Rolaids, right? It helps your stomach with the roller coaster that we've been on. But ultimately, investors do understand they should take the course, but sometimes what comes naturally intellectually doesn't always win out over the emotions. And people don't like to lose money, right? That's a fact of life. People don't like losing money, and it's not fun to watch your portfolio sink. But here are a couple of tips to help navigate through this time. And maybe that is why Lighthouse Capital is the name that I like to go by, because what does a lighthouse do, ladies and gentlemen? It helps you in the fog, and it helps when it's stormy seas, it helps the ships navigate the shore and that they don't crash into rocks or anything like that. Okay? I am your beacon. I am your lighthouse. Tip number one is to diversify. To understand this concept more easily, we have to define what it means to diversify. What is diversification? So diversification is an investment technique that uses many varied investments within a single portfolio. The idea behind diversification is the portfolio with different kinds of investments may, on average, yield higher returns and pose a lower risk than a single investment. Diversification tries to smooth out volatility in a portfolio caused by market, interest rate, currency, and geopolitical risks. In other words, right, in layman's terms, don't put all your eggs in one basket. It's important to remember that diversification does not it's not an insurance policy against losses, right? It's not going to necessarily prevent losses. Speaking about a diversified portfolio, some kind can be defined as like a 60-40 portfolio. BlackRock says the foundational 60-40 portfolio, where 60% is invested in stocks and 40% in bonds, is the initial starting point for many portfolios. The exact proportion of the mix is often adjusted based on an investor's time horizon, risk tolerance, and financial goals. But the simple proportional stock-bond combination is core to what is considered by many to be a diversified portfolio. The main premise for the combination is that when growth assets like stocks sell off due to economic slowdowns, fixed income assets like bonds typically appreciate. While stocks tend to suffer in recession due to lower earnings, bonds can rally because central banks typically cut interest rates to support the economy. When central banks ease policy, bond yields drop and bond prices rise. This dynamic means that bonds can provide a shock absorber in the portfolio, helping to cushion overall returns when stocks are falling. Now, even though the Federal Reserve has yet to cut interest rates, the market, right? The market is way ahead of the game. And the market is pricing in slower growth. And as such, bond prices have been surging over the last few weeks, actually since the beginning of the year. So the concept of bonds cushioning the drop in the stock market is alive and well, and it's really actually what's going on over the last few weeks. Tip number 2 is low correlation. What investors need to do is look at assets that have low correlation to the broader market. Here, we're going to define it as the S&P 500. The purpose of combining investments with low correlation is to provide greater diversification, so not everything in the portfolio moves in tandem. Nothing marches to the same drum. Certain market sectors that currently have lower correlation could be utilities, healthcare, consumer products, food and beverage stocks. I'm not recommending at all that you go out and buy these stocks. You have to do your own research. Keep in mind that past results are no indication of future stock market returns. But there, do your homework, find out sectors, stocks that are not correlated to each other. And that's a great way to end up diversifying. Tip number 3 is just to relax. Take a deep breath with me. Namaste. We've just concluded the yoga portion of the show here on the big podcast. I know it's not necessarily easy, right? Nobody likes to lose money, but you do need to relax and stay focused on your long-term goals. Broken record, right? But it all comes down to this. It's important to remember that markets do go up and down. And as I've mentioned over and over again, on average, the stock market has a 10% drop once a year. Okay, so keep that in mind. Markets go down. They don't always just go up in a straight line. As I've written, I've spoken about, I've spoken here. The worst thing you can do as an investor is panic and sell everything. And then wait, because you know to time things perfectly. You don't wait for the market to recover, and then I'll reinvest. You know what generally happens when that happens? You wait and wait and wait and wait. In the meantime, the market is like a rocket ship. It moves forward. There's all kinds of data that say if you miss, those special days, the top 10 performing days of the year in the market, your total return over time is like it's cut in half. It's not even close how much damage you do to yourself. So what do? Make sure, first of all, that you are allocated according to your goals and your needs, right? If you need the money in 3 weeks, you shouldn't be in the stock market. If you need the money in 20 years from now, okay, the market in the next 20 years is going to drop 25%, 30%, a couple of times probably, statistically. Just wait it, write it out, be focused on that long term, okay? That's what you got to do. Just relax. Make sure, though, that you are allocated correctly so that, no surprises, right? If the money in 6 months because you're buying an apartment and all of a sudden the market drops 30%, and you can't make that down payment, well, you're up the creek. So don't let that happen and back off on the gas. So that's the most important part in this whole thing is how you're allocating your money. There's nothing more important than that. But you also need to have patience, stay the course as well. There's no question about that. That's it. It's not so complicated. Just don't panic. Don't look. Okay? You've been tuning into the Aaron Katsman Show. We speak about your life, your money, and your investments. If you like this content, hit the like button below. If you've not yet done so, please subscribe to both the podcast and to the YouTube channel. And once again, if you know somebody who's panicked or whatever, feel free to share this with them as well so they can get some of my knowledge and that ultimately at the end of the day, they won't panic and miss out on opportunity down the road. Okay, thanks so much for tuning in. We'll speak to you soon.